Hi, good evening, everybody. Thank you, Shalini, Anand, and Ishtara for the wonderful session. And wow, what a wonderful conclave it has been so far. As I was listening, to the CEO panel, they shared their vision, strategy, how sustainability makes business sense, and is a great opportunity into the future. In the last fire chat, we saw our youth, share their sustainability aspiration. But frankly, what we need to convert this vision, strategy, and aspiration to action is funding. And hence, I am really, really fortunate to have the opportunity to welcome all of you to this most relevant panel discussion on sustainability needs funding. Uh, we all know we expect our investors to take ESG considerations into account when making funding decisions. We expect transparency to highlight the risks and the mitigation measures related to ESG in this journey. And hence, I believe sustainability finance has a key role to play in delivering on our India net zero aspiration by 2070. To know more on this topic, we have a star-studded panel today who will share their thoughts for the next hour or so. I first welcome our moderator for this panel discussion, Anjali Bansal, who is president of BCCI and founder Avaana Capital. I take great pleasure in also inviting our very diverse and distinguished panel members, Mr. Rokas, Peciulaitis, founder and managing director for Contrarian Ventures, Mr. Sridhar Narayan, managing director GEF Capital, Mr. Arunabha Ghosh, CEO, Council on Energy, Environment and Water, and last but not the least, Ms. Ruchira Shukla, VC Regional Head for South Asia from IFC. I look forward to this panel. Over to you, Anjali, to take this further. Thank you.
Thank you very much, Mahesh. And I'm echoing what Mahesh just said. And we were backstage, we were saying, my God, the last session is a tough act to follow when you see the energy of our young people. But it also gives you so much more sort of hope that we have a very bright future ahead with young people like that. So on this discussion today, we will very much talk about money and financing, right? Because capital talks, capital has a big voice, and one of the big movers really in the sustainability dialogue has been large capital. In the session before this, we heard how a coalition is coming together of large institutional funders, $42 trillion, that is looking at sustainability as a criteria for investment. Before we jump into sustainability today and financing, and we will have a very, very nice cross section here in a spectrum really of very early stage technology investments from Contrarian, then growth stage from Sridhar, and then Ruchira, who as a VC regional lead for IFC, actually looks across the board. She looks at both funds because there are LP, fund of funds, as well as indirect investments. But I'm going to start with Arunabha. Dr. Arunabha Ghosh, you were at Glasgow in the thick of all the discussions, driving a lot of the Indian dialogue. What did we take away from COP26 and what is the road for India from COP26?
Thank you, Anjali, and thank you very much to Bombay Chamber of Commerce and Industry for inviting me to this important panel. I am particularly excited that we are having this conversation just 3 weeks after COP ended, because that just demonstrates that the signals that India set out were not just words in a speech from the Honorable Prime Minister, but that industry and within industry, finance is particularly interested in where this goes. So let's ask ourselves where this goes. I believe that the Prime Minister's statement on 1st of November was a statement not of an energy transition, but of, or rather for, an economic transformation. Net zero by 2070 does not mean just that we'll have more renewables or more electricity, but it basically means that every single sector is going to change. It means that how you make an automobile, to how you make steel, to how you make the shirt, everything is going to be now evaluated on a completely different set of metrics. Therefore, we have to ask ourselves what is the near term and then what is the long term. The near term target of, say, 500 gigawatts of non fossil capacity, most of which would be renewables, by 2030, effectively translates into the fact that during the course of this panel, India should deploy another 10.5 megawatts of renewables. Every working hour, 10 hours a day, 6 days a week, 52 weeks a year for the next 9 years, we have to be deploying at that intensity. which means every time there is even the sound of a tender, the taps need to turn on and finance needs to flow. The second thing that needs to happen is that we need to get very real about de-risking. Our estimation at CEW is that the net zero road will require a $10.1 trillion investment in 2020 prices. But of that $10.1 trillion investment, we need about $1.5 trillion as the the lower cost or the hedging capital that will be needed to lower the cost of finance and crowd in additional investment. So there is no chance of getting to big green infrastructure without getting serious about large scale de-risking of investments in India and in other emerging markets. The last thing, at least at this stage, I want to say is that the road to net zero for India and for other developing countries has to be one where the energy transition comes closer to people. Otherwise, we will not get the political sustainability for sustainability. We will not get the political dividends coming in the form of votes for political leaders beyond the current government to actually keep driving this agenda. And this will only happen if large capital begins to flow through innovative mechanisms into many, many types of small projects, whether it's in urban areas, peri urban areas, or rural areas, which allow for a more distributed, digitized, and decarbonized economy. So let me stop there and then happy to get into more discussions as we go forward.
Thank you, Arunabha. And that is a very neat segue into some of the questions. And I'm going to put questions up and request actually anybody to respond, please. I mean, we all know this, right? For countries, companies, as we target net zero, and India is targeting net zero by 2070, both public and private capital have to play a very significant role. So we've already talked a little bit about public capital. Today, in this session, we will focus on private capital a little bit more. Let me start with Rokas. Rokas, you are at the absolute sort of cutting edge of some of the very early technologies that will make or enable these transitions to take place. What are you seeing in terms of appetite for global capital to invest very, very early and take some of this very early gestation risk? And on the other hand, the kind of opportunity or the pipeline you see in founders across the world that are investing their energy and time in, whether it is in adaptation, resilience, mitigation type businesses.
First of all, thanks a lot, Anjali, for invite and for a possibility to participate in this panel. So yeah, we're early stage investor, and I think I kind of want to shift the question a bit to answer it at the end. I think it's a great time of point of history where we are in terms of where the capital flow starts to flow. And I think in every discussion about net zero, one needs to start with a discussion about where the capital flows now and where it will eventually flow. As these ginormous numbers out there, usually people forgot about speaking about billions. Now it's trillions we're talking, as mentioned before. And what's interesting to look is I think every time we look, because we're tech focused, so we imply to invest only in technologies that contribute to decarbonization as part of net zero journey, whether that's a country, a company, or a city. And I think the way we look at it, and a bit more in India's context, you always want to start with the accounting question. Where does the emissions come from? And then you'd establish the baseline of where the opportunity lies. And I think in every discussion that we look at, and I like this narrative, that eventually of those trillions of dollars, majority of the opportunity is actually in infrastructure. Because what we think now is an infrastructure, for example, a solar or a wind, was a technology just 12 years ago. So I think what we do as a fund, we actually invest in technologies that are technologies now, but that will become infrastructure in 10 to 12 years. Things like hydrogen technology that will eventually become, once the levelized cost of the systems and ability to produce a competing price to fossil fuel alternatives, which reach the point that will have inflection where these technologies will deploy at scale, and then those trillions of dollars will be spent. And I think, such in India's context, I think when I look at emissions, which is roughly around 5% of total global emissions, the majority of that part comes from heat and electricity, as well as obviously industry. So that's roughly 75% of total emissions. So obviously for industry, there's one particular, I would say, challenge and opportunity at the same time to go and potentially deploy hydrogen, green hydrogen at scale, and to basically be a substitute for, the current, brine hydrogen powered by gas or other alternatives, how the industry is powered. For example, one being coal. So I think the way we look at it is the timing is an amazing point where I think what we invest now at C stage in technology will eventually in 10 to 15 years become an infrastructure. And if you look at that different way, there's just enormous amount of capital coming through what I call climate stack. So from infrastructure to growth fund to venture, venture debt, and especially at the early stage. But I think, in my personal opinion, I'm biased, I guess, but I think still that I think still underfunded part is really the early stage, because while the technology that we'll invest today is only become deployable in 10 years once you de-risk that, I guess the cycles have accelerated given the funding availability, but still, I would say to the minimum 7 years. That's normally that type of amount of time we make the best that we invest in early stage companies where founders have ideas. So I think it's a very exciting time. I think it's a great opportunity. I think every technology eventually is an infrastructure, and I think we're at that point where we're just building some of the technologies that will become future's infrastructure. So that's my 2 cents to that discussion, Anjali.
Thanks, Rokas. Sridhar, you've been a long-standing investor in environment as part of the Global Environment Fund, and you're probably one of the few people who have actually seen cycles in sustainability and climate investing. So, what are the differences or similarities you see between the last cycle and this cycle? Are we in a better place today? Will we actually have more opportunity and generate better returns? Which, of course, as we know, returns generate their own sustainability for
Yeah.
investments. What's the nature of entrepreneurs and opportunities that you see?
Thanks, Anjali. Yes, indeed, there's been a significant change in the last 15 odd years that we've been investing in India. Our platform, of course, has been investing for several decades in other parts of the world. But in the last 15 years or so that we've been active in India, we've certainly seen a marked maturity in some of the environment related sectors. The renewable energy sector is a great case in point where when we first started investing in 2007 and 8 in this sector, it was very largely dependent on subsidies and policy benefits. And that sector has now matured to being a market based, more competitive sector now. And as a result, there is a whole clutch of entrepreneurs also who have now got into that sector because they see this as a viable industry that can stand on its own without the need for a lot of subsidies from the government. We see similar transitions underway in some of the other sectors. Electric mobility, I think that's still at a somewhat early stage. Waste and water treatment, these are also other sectors that we invest in. And we do see that each one of these sectors goes through its own stage of growth and maturity, where in the early days you require a lot of government support to make business models viable. But there comes a point of inflection which the electricity sector uses a term called grid parity, but there is a similar parity that exists in almost all other sectors as well, where the business models move from being dependent on subsidies and government support to becoming more commercially viable and standalone business models. So we are seeing that transition happen. In some sectors, it's faster than the others. And that brings with it a certain market opportunity, a certain set of entrepreneurs who are therefore willing to play in that sector. And one of the sectors that we've seen that happen in addition to energy, is water, where just as you had grid parity in electricity, for many years, water treatment and wastewater treatment was really driven only by regulatory requirements. But there is now a point in time where the cost of fresh water has risen so much that you are better off using wastewater treatment and to recycle some of that water. So that's the point of inflection or parity that we think will happen in many different industries. And that presents a lot of investing opportunities for us. That's really the transition that we as investors also hope to play, that you come into a sector where you're still at a somewhat late stage. on the early stage of the growth path, and then we ride out the whole transition to mid stage. That's where we think we can create an alpha as investors.
Thank you, Sridhar. In fact, water is something we spoke about in one of the earlier sessions, and with Neeraj Akhoury from Holcim, Ambuja Cement, actually talking how they have now got to 8x water positive.
Yeah.
And just goes to show if you set a goal, it is achievable.
Yeah.
Ruchira, I'm going to turn to you to put sort of the capstone on this stage-wise discussion that we've had. With your perch at IFC, and given that what we know today of the need for blended finance, you need equity, you need debt, sometimes you need also capacity building and non-returnable capital, particularly for long gestation. How do you see this space evolving, both from the emergence of new, very early stage funds, as Rokas was mentioning, there seems to be a dearth there, as well as some real opportunities for creating returns, and IFC's role in supporting the development of this space? So, big question, which is why I kept it last with you.
Absolutely, Anjali. I must echo that this panel is so important at the stage where we are, and on the back of COP26, there is now an urgent call to action. And what I've seen change in the last decade is, if the sensitivity to carbon and to creating a low carbon economy was present even a decade ago, it was a nice to have. And now it's a must have. It's an imperative that nobody can avoid. And we are seeing that shift in the minds of all stakeholders. Regulators across the world are making commitments and trying to make the right changes happen just to make that the shift pan out. We are seeing entrepreneurs think differently about their business models that are more climate friendly, sustainable in the long run, and thinking about the future of the planet. We are seeing investors become more sensitized to it, and a lot of new emerging VC funds, when they come to pitch to us in our role as LPs, they present not just this is my strategy and here is my path to bringing the IRR, but they also present sustainability frameworks. There is a very distinct assessment of how the fund meets UN SDGs and how the fund meets various development impact objectives, including creating a low carbon planet. And we're seeing that also in a lot of innovations. So there are innovations that will require blended finance, as you rightly said, Anjali, and maybe a long gestation period, patient capital. But there are some that can get economically viable in the short term, and we're seeing a lot more of those these days, and we've backed some of them. We have backed recently a company called Appeal that has built a plant-based coating for fruits and vegetables to extend shelf life. And that reduces food wastage, it reduces the need for refrigeration, it reduces the need for plastic packaging. And these kind of solutions are often seen coming out of developed economies where they're able to get financial viability quickly. And once they've proven that financial viability, can then cross subsidize their entry into emerging economies where price points and affordability might be lower, but the solution is already established and can scale in those markets. We also have an exposure to a company called Pattern Ag that is looking at soil DNA and looking at analyzing soil DNA to assess and give farmers informed decision making tools on reducing, managing pests and disease in order to enable more precise fertilizer usage. So a lot of these applications are highly innovative. It's not what we were seeing a decade ago, and that's because of every stakeholder waking up to the problem. We are seeing a lot of solutions around Earth observations, where, and we've invested in a company called Planet, which recently IPO'd, and they are launching satellites for Earth imaging to allow for better management of decisions around forests and coastlines and farmlands with the data that's gathered through the satellites and the analytics built on top of it. So, there is a whole spectrum of solutions from agri to food tech to, data analytics and satellites to even manufacturing. We are moving to a world where the ambition is for zero emissions manufacturing. 8% of the global carbon emissions come from steel production. And that's a sector that's very hard to decarbonize. We have, through one of our VC funds, exposure to a company called Boston Metal that has come up with a very innovative, emission free production for steel. It's it's in its path to commercialization. It's early days, but the fact that we're seeing some of these green shoots is very promising, and I think we're heading towards a future where capital will come because the viability of these models will eventually get established, and I'm very bullish on being able to meet these goals.
That's great. Which takes us to government and the role that policy is playing and needs to play. And we know that policy is already playing a fairly proactive role here in India and indeed across the world. What is the lens on public financing, Arunabha, if we can turn to you for that, and then back to the rest.
Well, before we come to public financing, Anjali, one of the things that needs to happen is a realization that we've squeezed every last drop, pretty much, at least in the renewable sector, on the back of a very dysfunctional power sector in the country. 11 years ago, when the solar mission was launched and we had only 20 megawatts of solar capacity, most energy analysts would have said renewables did not have a future in India. But India defied those skeptics, and putting out 101,000 megawatts of wind and solar and biomass in this period is commendable. But that's not just low hanging fruit. I would say it's even middle hanging fruit. It's somewhere even towards the higher hanging fruit. Now, no more fruit can be plucked unless we start reforming the power sector. The Electricity Act is in Parliament, and I would think that that has to be the first big signal coming out of India that we are reforming the power sector in order to drive the next stage of reform, next stage of growth in the clean energy investments. That said, on the finance side, public finance does have a role. And number one is to move away from project financing. An entity like IREDA should not be doing project financing at all anymore, right? It should be only doing de-risking and only doing sort of market enablement kind of work, which is also the kind of catalytic role that the multilaterals can also play. On top of that, however, I think we need to use public finance to deepen the debt markets. If we need about $200 billion of investment for just renewables over the next decade, another $200 billion for our electric mobility targets, another $200 billion or so for green hydrogen, all of this happening just in the coming decade, we simply don't have deep enough debt markets to facilitate that. The entire entire banking sector's exposure to the power sector is $160 billion. And we are saying everything put together, we need more money than that just for renewables. How will that happen? Subsidized credit enhancement from using public money is absolutely critical to solve the sort of impossible trinity that we have of shallow debt markets, poorly rated projects, and high cost of hedging for international capital. That is why we need subsidized credit enhancement in India using public finance. Our estimation is that even something on the order of about 4,500 crore could drive about 72 to 80,000 crore of private debt inflow into the clean energy sector. But that's just one example. The other thing that needs to happen, and Ruchira was giving several examples of companies they are looking at. I think what needs to happen is that India needs to combine its obsession of having more unicorns with making sure that those unicorns also emerge in the clean energy space, which means you need a different kind of patient capital, along with some kind of publicly funded, whether it's tax incentives or other kinds of incentives that enable the digitization folks and the clean energy folks to come together and innovate and develop business models that are bespoke for emerging markets like India. So public finance is needed there as well. The next place I would say public finance is needed is in the de-risking of critical infrastructure in the face of severe climate risks. Today, if I want to build a bridge, that's not energy finance. But if the bridge is going to get washed away in 15 years out of its 50-year lifespan because of an extreme weather event, You need to be able to create the insurance cushion that allows that bridge to be financed. So whether you're looking at bridges, roads, telecoms, or airports, making climate resilient infrastructure means that there will be a delta that will need to be covered for non-linear climate risks. And that again will need to come from public finance or innovative, internationally funded insurance mechanisms.
No, excellent point there actually on de-risking. So it's not merely providing the financing, we're talking equity and debt, but also de-risking some of that investment and the longevity of those businesses. But there's an interesting point, and I'll just pick up on what Ruchira was describing earlier. We are actually starting to see the emergence of a lot of startups now, even in the climate financing space. So companies that are thinking about EV financing. And as we know, to create a credit model for electric vehicles is quite different from, say, ICE. And using a real-time, always connected vehicle, gathering the data. So I think there is so much happening today on technology and the innovation front, both in terms of hardware, so development of sensors and so on, and the shifting of cost curves, that it makes the deployment of technology more ubiquitous, more possible in areas like agriculture. And agriculture, of course, is a very significant sector, both as an emitter as well as a user of resources. So if we are able to arm farmers with better information, better, analyzed climate data on their input side, and provide digitized supply chains on the output side, we can actually do a lot to counter wastage and indeed to create resilience and better farmer incomes as well. So on that, Rokas, turning to you, since you look across the world, what are some of the coolest new technologies? And the bar is high on the coolest new technologies that you're seeing coming out to address climate change and sustainability.
I think, Anjali, I think this is very interesting discussion, by the way, by everyone. And I have just one point before that. I think a lot of people refer to this, we're going through it as a transition. I actually believe that transition is a very short period of time. No one can guesstimate how long it'll take, but we're actually going through. It's not a transitionary period to something. We're actually not transitioning to anything. We're actually going to a completely new system in a context of energy and mobility, for example. And what's interesting with that system is not, for incumbents, for example, that are going through that transition, what they call. In reality, they're either transforming their business or they're going out of business. And it's just the question when, basically. And that when is when people try to say, oh, when is certain technology going to work, whether 2025, 2030, 2045. Actually, in reality, if you look at the kind of, I would say, line towards net zero by 2030, 2050, 2070 in some cases, I think what I like saying is, we usually overestimate what will happen in 3 years, but underestimate what will happen in 10 years. And I think that's in reality how I look at betting and technology. People overestimate what will happen in 3 years, but underestimate the change will happen over 10 years. And I think, answering your question, Anjali, I think interesting technologies are the ones that are not just improving, they're not features, they're by design completely taking the system and saying this is false how we've done it. And what's interesting about when you think about it, the transition what we're going through is very simple. We were burning stuff, and that was finite. We're going to a system that is infinite, and we're not burning stuff. And the commodity of choice of the last 100 years was basically shaped by geopolitics, economics, some wealth made for certain geographies, and that choice was oil and gas. We're transitioning now to an economy that will be powered by a completely different set of commodities. And primarily, the ultimate commodity will be electron, as in electricity, right? And what's fascinating with electron is that it's actually a very simple commodity, right? It's more of like when you think about what telecommunication industry went through like a super complex infrastructure, they went to a data model, basically. Like eventually what is now internet is just a bunch of servers all around the world trying to optimize it. And it's really a software problem, not a hardware problem. Hardware is just a neighbor of the software solution. So what's interesting in this new system, what we're transitioning to, I think it's a new system. And that system does not have byproduct like oil or gas. It doesn't have a complex product to which you take and you make plastic, you make, a bunch of other products that come of it. It's actually just an optimization problem that is primarily driven by the flow of how electron flows. And that's just an optimization of resources. So what I truly believe, what's interesting in kind of the technologies, whether that's satellite, EO technologies, what I think was mentioned before, whether that's pure software to accelerate deployment of infrastructure, or whether that's even in context of we are not investing in the company, but cobalt minerals, just better exploration of the new commodities like the rare earths or the nickel or cobalt. I think everything implied is powered by software, whether that's better prediction of where the next natural resource is, whether that's prediction of how you utilize that resource, or whether that's how you deploy that resource. So I would say I wouldn't want to bet on something. There's great companies as part of our portfolio and as part of others, but I think ultimately software is eating the world, as Mark Anderson said, in enterprise SaaS, but it's really eating the world from a climate context as well. And it's implied the primary beneficial. And for me, like what's most fascinating is people refer to it as green industrialization. But we're really going through a point where back in the days, Rockefeller and JP Morgan went to create oil as a commodity and powered that 100 years of growth for industrialization. We're going in the exact same point where them, like Edison, was an inventor that we'll see the Edisons of this day. And the days of people who build technologies like oil as a primary commodity, and they will power the next not 100 years, they'll power it infinite because it's not a finite commodity. So I truly find it fascinating what the kind of point that we're going. People a lot of talk about cycles in 10 years. I think this is a cycle of 100 or even 200 years, And we're just literally scratching the surface of it at the very beginning.
No, that's fascinating. And as we know, sustainability is actually the next digital. So 20 years ago, we did not think about digital as embedded in our business systems. But today, you cannot think about any business model without digital. Similarly, in my view, at least sustainability is going to be that way. It has to be a horizontal, embedded in every single part of an enterprise. We talked to a lot of the larger enterprises earlier today. Uh, Speaking, coming back to where does financing go today? And where do you see the trends now in capital flows? Arunabha brought up debt, of course, and de-risking. Sridhar, as you see this, the equity debt play and applying the India lens, what are the sectors that are seeing actually more investor love, and where do you think more capital needs to be diverted and channeled to some extent?
Yeah. No, I think firstly, Arnaba made a very interesting point about the role that debt capital plays, particularly in the form of guarantees. So, one of the things that even we as equity investors, when we look to invest in some of these business models which are very capex heavy and therefore dependent on debt, one of the areas that even we are looking for better clarity is whether the debt markets themselves are deep enough to support some of these models. And there, I think agencies like multilateral agencies have a role to play, not by providing actually the debt capital, but by maybe providing risk mitigation measures and guarantees, which can then crowd in regular debt capital markets to come and fund some of these projects. So, as an equity investor, we are certainly looking for some of that maturity to set in even in the debt capital markets, because that is how we as an equity investor can start to underwrite the alpha that we are looking to create from some of these investments. As far as equity flows themselves are concerned, Anjali, if you look at both the private and the public markets, sadly, today there is a lot of greenwashing that is happening. There is a lot of talk about capital that is looking for investing in green businesses and ESG compliant businesses, but where they are ultimately ending up is really just ticking a box. And a lot of that tick the box is happening because people feel compelled to be seen as investing in green businesses. A lot of that is not genuine ESG or green investing, it's just greenwashing. We as investors, therefore, our wish list is that there needs to be a much better form of taxonomy that needs to be in place for investors to really measure what green investing should mean. That taxonomy in our mind should cover both climate mitigation and climate adaptation. Because the reality is that there will be a number of industries which will have to go through a transition process. I mean, today, for example, we could sit and say that we should not be funding any more coal power. But the reality is that thermal power is required for a period of time. In that period of time, there may be business models that can make that thermal power cleaner and greener. For example, flue gas desulfurization. So, a company that adopts technologies like that should have a taxonomy which gives it credit. That's the only way capital can flow into some of these transition models as well. So, when we look at different industries, I mean, we are again an investor where we look for both adaptation and mitigation. The largest industries that we are focused on are therefore energy, mobility, and agriculture and construction. These in our mind are the four sectors which have the biggest environmental and climate footprint. And we are open to various kinds of business models in each of these industries. The challenge that we face is there is no standardized way of measuring how businesses can really create a positive environmental impact in these. Energy and renewable energy, in some sense, is a very mature industry by that measure because it's very simple to measure the impact of solar and wind. But when you get into mobility, when you get into agriculture, when you get into construction, it's not that easy to measure. So I think some of that framework needs to fall in place. And frankly, even on the public markets, I think there are ways of directing capital to make sure that they achieve the desired purpose. I mean, today there are a lot of indices being developed to measure ESG investing, and various agencies are creating ESG indices. But I think there is a more impactful measure that can be done, which is over a period of time, why can't we say that all of the companies that need to be even in the Nifty or the Sensex should meet a minimum taxonomy score, right? That's the only way you can direct large amounts of capital to companies that are compliant with ESG norms.
Right.
So I think some of those are measures that we as equity investors would certainly want to see getting done to direct capital into these areas.
So it's a good point. I think the Indian regulator is taking a front foot on this with the new BRSR
Yeah,
standards that are being put in place and reporting. And of course, globally, the Task Force on Climate-Related Disclosure has put out some set of uniform norms. Ruchira, turning to you, what are the kind of sort of metrics, both in terms of evaluation and underwriting, but also to keep things honest? Are you seeing whether it is funds or companies, KPIs that you are advising them to use? And what are the metrics that are being adopted today? And where should we take this dialogue? And IFC plays such a seminal role in that dialogue. Where should we take that dialogue?
Absolutely, Anjali. I'll pick up on what was being said earlier, and actually 2 points. So I'll talk about the metrics, but before that, I'll also talk about this thing about how multilateral institutions can play a role. And Sridhar, you raised that point, which is very important. And we're beginning to do some of that, but I think anything that's done right now is not enough. There's a lot more required if we have to meet the goals we're setting for ourselves. But we typically do that by providing that first loss guarantee
exactly.
and creating structures where that with that first loss guarantee, other financial institutions become more comfortable about opening up deadlines, and that then, as you rightly said, allows equity investors to become more comfortable. Um, Interestingly, as you pointed out, there is a bit of greenwashing going on. So the tricky part there is assessing where do these tools need to be applied, because it's very easy sometimes for what may actually have a model that may have the ability to stand on its own feet and be commercially viable to then come back to you and say, hey, by the way, let's get this kind of first loss protection. And we have to then have some very tough discussions internally and say, look, this actually should be standalone, it's commercially viable, it should attract commercial venture capitalists. And this model, on the other hand, is more high risk, it's likely to take long to prove itself out, and therefore requires that first loss protection. So the availability of the tool and the very selective application of the tool is where a lot of our minds and energy get spent. On the scoring bit, Anjali, we ourselves as an institution have some scores in place. So every asset that I invest behind is scored on ENS, it's scored on impact, and it is tagged, whether it's a climate tag or not. And those are assessed by different teams. So we have a team that does the impact assessment. which looks at various metrics of development impacts. It's not just climate, but it could be, for edutech, it could be students reached. For health tech, it could be patients reached, and drugs dispensed, and lab tests conducted in underserved areas, and how much of the revenue is coming from tier 2, tier 3 locations. So we've created a very rigorous framework on impact assessment. Similarly, we have our framework on environment and social standards, various performance standards that we expect our investee companies to abide by, as well as the investees of our portfolio VC funds to agree to follow. And there is a team that assesses that ex ante before we've done the investment, and estimates what is likely to be seen and where work needs to be done. We give them an ENS action plan with each investment on the first day we go in, and then we monitor it on a regular basis to see what is the progress against the ENS action plan. And then obviously, and the climate tag is a binary tag. You get a climate tag if the investment is shown to deliver on certain climate metrics, and the biggest metric we follow there is the reduction in GHG emissions. So we estimate that, and then if it's above a particular threshold, we tag the investment, a climate tag investment, and then follow through later on to ensure that actually plays out. But these are our metrics, and I'm sure other institutions have their metrics, and every VC fund is setting up its framework. I think the one thing that's needed here is some standardization of not just taxonomy, and I agree with you, Sridhar, you mentioned taxonomy, but the metrics, right? So we need to move to a world where there is a common framework and a common way of thinking about an ENS and a climate score. And if everything is scored on one framework, then that's calibrated across different assets and sectors in a country, different countries across the world, and that will allow us to give us a clearer view and solve this problem of greenwashing, so that we know that where the dollars are going is actually moving towards this objective of a low carbon environment.
That's an excellent point, actually. A common set of accepted metrics and standards. I mean, no one debates how to measure ROE, right? So the return on equity, there is one way of measuring ROE.
IRR is one formula. Excel knows
it. One formula. So we need to have one formula for maybe 2 or 3 sustainability / climate related metrics.
I actually want to touch one thing actually, which I think is very important. I actually don't believe that there will be one metric, because every kind of different issue that you tackle, specifically in the kind of carbon market, for example, if you take carbon market, it's a separate thing that needs to establish, right? To take an efficient market, everything, what drives the quality is the data availability, and for a lot of things like climate mitigation. So I personally believe that there will be a discount rate and impact calculation, which will relate to the climate risk. But you have to have a lot of data in order to enable something that every financial institution would rely on. And that's literally availability of the data. Same way in voluntary carbon markets, right? You look at voluntary carbon markets and you look at breakdown. Last year, 1.2 billion traded. You look at that, and really the majority of those carbon offsets that have been traded there are like around $8, and those are of low quality. And everyone's claims that 1 ton that they offset that they bought by, I don't know, doing reforestation or soil or something else, they claim that it's 1 ton. In reality, it's not. So we actually invest in a company that is building S&P ratings for Moody's for voluntary carbon market, because in reality, only a few companies like Microsoft, Stripe, and Shukla went and looked at carbon removal, for example, market, looked at 300 technologies, and only said that there's 2.1% the ones that were eligible to pass through their methodology. And that's a methodology that they directly build with scientists from MIT, Stanford, etc. And that's the kind of what we call edge or advanced set of carbon removal markets, which usually on average cost not $8, they cost around $650 per kilo to offset. So I think what's interesting is that you will at some point need someone building a methodology that feeds through a lot of multiple data layers to come up that something becomes bankable. Eventually, financial institutions will rely and make decisions on whether someone is actually greenwashing or not. But it feeds down to availability of that data, and I think we're still early on the game. And I think that's what I believe for the 10 years, we're not going to have standardized, because it's hard to agree, right, on something. Because for certain countries, if you look at the accounting principle, certain sectors will be more important than others because that's where their emissions coming from. So they will kind of be willing to go for something, but not for the other because that doesn't solve their problem. So I think we'll have till then a lot of different methodologies, as a matter of fact. But the ones that matter is the ones that are bankable, really. The ones that are non-bankable, they don't matter at all because it's someone's interpretation of it basically. So I find institutions play a tremendous role because they will be the ones betting with money whether something's greenwash or not. And in reality, that's the true bet. Like how we bet on technologies, whether something works or not. We just have more room for error to be wrong than them financing those from debt instruments. Sorry
No,
for
very
just
good
jumping
point,
in there.
Rokas. No, absolutely, very good point here. Keeping an eye on the clock, I'm just going to ask one final question, which anyone can take, and then we'll do closing comments from everyone. We've talked about public finance, private finance, equity, debt, long gestation, new technologies, and so on. What about the role of academia and research? So what is the role that universities and corporates and corporate VCs, but also corporate R&D play in financing innovation and climate change, or climate mitigation rather, for anybody?
Maybe I'll take a stab at this because it's a bugbear I carry around. Last year I co-chaired the energy and climate track for India's sound science, technology, innovation policy. It's the only fifth time since independence that India has come out with such a policy. And here's the frustration. I mean, apart from the fact that we don't invest enough in R&D, we are certainly not looking at transformational R&D. So the suggestion that we looked at least in the energy and climate space, is that can we bifurcate the technologies that we call transition technologies, basically like energy efficiency, things that you can do right now, makes you a little cleaner as you go along, and then foundational technologies that are not just about a particular sector, but are beginning to impact a range of sectors. So green hydrogen is one such. You can't do any kind of heavy industry without a clean industrial fuel. But equally, similar to what Rokas was saying, you need technologies that can suck carbon out of the atmosphere. And because we're talking about net zero, we're not talking about zero. So where's the net going to come from? Similarly, you need completely new technologies that are looking at, the circular economy of materials. So these are things that are completely missing. So the question about R&D is not how much more money to spend. Actually, if you look at ARPA-E, the Advanced Research Projects Agency for Energy, the actual public investment was only about $1.5 billion. But that crowded in about 17 times that kind of investment in the R&D that came from private sector. So are we saying that we don't have 10,000 crore to invest
No,
in?
so what we are saying is catalytic capital, Arunabha, right? What we are
Exactly.
saying is catalytic
But
capital that
but
will
directed
jumpstart.
towards transformational technologies, not tinker around in the
Right.
margin.
Great idea. And one way I think which we should take away from this summit for sure is creating that pool of capital, catalytic capital in India. Thank you, Sridhar. Closing comments to you, and then last word with Ruchira.
Thanks, Anjali. It's been a real pleasure being on this panel with all of you. Like I said, we at GF Capital have been investing in these environmental sectors for many, many years. We remain committed to investing significantly more pools of capital here in India. We are a classic mid-stage growth private equity fund, and therefore a lot of the industries that we necessarily invest in are industries where the business risk and the technology risk have somewhat been taken away. The good news is that increasingly we are finding more and more such investment opportunities here in India, which is a great sign. It shows you that these sectors are coming of age and maturing in India. These are not just early stage business models, but these are business models that are maturing. So yes, we remain committed to putting more capital to work here.
I'm super excited to see the appetite. As an early stage investor in this space ourselves, we are seeing just so much coming through in terms of new technologies and the kind of entrepreneurial talent going into this space. And I think Arunabha, you mentioned unicorns. I'm very confident that in the next not too many more years, we will actually start to see real unicorns emerge in the sustainability space itself, whether they are coming out of mitigation, adaptation, or resilience models or transition. But we will see very large, very exciting new companies emerge here. Ruchira, last word to you.
Thanks, Anjali. So clearly, we are seeing a lot of opportunities. That's something that came through consistently by all the panelists today. India is the space where we have a lot of capital. Fortunately for us at this time, capital is flowing in, and both from the public sector side and the private sector side, we have the brightest of minds. We have a lot of will across stakeholders and a lot of energy to get things done, not just for the world, but not just for India, but also for the world. So India can build solutions that will solve the carbon footprint issue globally. So my call to everybody out there is let's put our energy and our capacities together and solve together.
I promised you the last word, but I cannot resist this. I think this truly is an opportunity for us to do what we have done in India multiple times, leapfrog, and show the world. We've done that on telephony, going from fixed lines to mobile, on payments. We've literally just kind of leapfrogged over the debit card, credit card, and gone straight to UPI payments. So, Ruchira, from your mouth to that of wherever, to entrepreneurs, and let us build in India for the world as well.
Absolutely.
Thank you all so very much for this very interactive, very exciting discussion. I know I'm feeling very enthusiastic, and I have no doubt all the investors here are going to get besieged by entrepreneurs who are attending the session today.
Oh, look forward to that. Thank you for having us.
Thank you, Ruchira, Rokas, Sridhar, Arunabha.
Thanks so much.
Thanks, everyone.